Hi, I'm John Persinos, Editorial Director of Investing Daily, with the video presentation for Monday, January 10. To view our full range of publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The first trading week of 2022 was rough on equities, especially growth sectors such as technology and communication services, while more value sectors such as energy, financials, and industrials got a boost. The catalyst for the rotation? Rising yields and tighter monetary policy. I expect this stock rotation to have legs as 2022 unfolds. According to minutes released last Tuesday of the Federal Reserve's December 14 through 15 policy meeting, the U.S. Central Bank is considering raising interest rates this year sooner than expected to fight inflation. The Fed also is contemplating a faster taper of its asset purchases to wind down its balance sheet. The 10-year Treasury yield has risen from 1.34% in early December 2021 to 1.77% by the end of last week. The major stock indices in the U.S. and overseas closed lower last week. See the following chart. The tech-heavy NASDAQ composite got clobbered last week. Overseas equities fell as well. Central bankers in Europe, specifically the Bank of England and the European Central Bank, also are planning rate hikes this year. Rising interest rates hurt growth stocks, e.g. in the technology sector, in favor of value stocks. The following chart provides historical context by comparing the movement of the NASDAQ and Treasury yields. As you can see from this chart, there is, roughly speaking, an inverse relationship between yields and the growth-oriented NASDAQ, which is, of course, dominated by technology companies. The arrows on this chart highlight periods when rising yields were particularly strong catalysts. Meanwhile, the December jobs report released last week provided a good news, bad news scenario. Take a look. The headline number of 199,000 non-farm jobs added was a disappointment versus consensus expectations for 400,000 new jobs, but the average hourly earnings figure surpassed estimates, hitting 4.7% year over year compared to projections of 4.1%. The unemployment rate dropped to 3.9%, as labor participation held steady at 61.9%. Tepid jobs growth combined with higher wage growth indicates a tightening labor market in the U.S. The Fed's calculation in 2021 was that it could have kept inflation lower only at the cost of a slower employment recovery. The latest jobs data show that this balancing act appears to have paid off, but now inflation must be dealt with. Fed policymakers also need to digest the uneven pace of jobs growth as broken down by demographic group. Comparatively higher levels of unemployment among minority groups suggest that the Fed might be reluctant to turn the monetary spigot too tightly. Also keep in mind, the Fed's last meeting occurred before the Omicron variant started to gain in ferocity. I continue to recommend value equity plays in the first half of 2022, but rising rates and slower corporate earnings growth will continue to generate volatility. As of January 7, 93 S&P 500 companies have issued earnings per share EPS guidance for the fourth quarter of 2021. The information technology and industrial sectors have witnessed the biggest increases in the number of companies issuing negative EPS guidance for Q4 2021 compared to Q3 2021. This chart tells the story. Overall, for the fourth quarter of 2021, the estimated EPS growth rate for the S&P 500 is 21.3%. The growing pessimism of analysts regarding technology largely derives from the dynamic I've just discussed, to wit, rising yields and the Fed's professed intention to raise rates at least 3 times this year. The pandemic and rising inflation are derailing economic and financial forecasts that seemed so solid just a few weeks ago. The economic recovery remains intact, but we're witnessing a rotation from growth to value. Calibrate your portfolio accordingly. If you're looking for a trading methodology that makes money despite the risks I've just described, visit the URL you see on your screen right now. Well, that's it for now. Thanks for watching. Please stay invested and stay safe.